I mean, if we are talking about pensions, right? So in Germany, basically, we have a three-layer system, right? So you have the statutory pension scheme, so gesetzliche Rentenversicherung, in which basically every employee is, except that's kind of similar are the professional pension systems, so like berufliche Versorgungswerke. So for lawyers, architects, tax advisors, medicine, and so basically for freelancers, right? So Freiberufler. So and you have Rürup, which provides basically the same, but from a tax point of view, even more, right? So and that is basically was created for self-employed people.
I have one, for example, because I don't pay into the German public pension.
So, right? But also people paying into a public pension, they are allowed to invest into Rürup because Rürup has higher deductions. Or you can pay more into it and still get a pension deduction. Let's put it this way, right? So then the second layer are basically company pension schemes, like Direktversicherung or Pensionskasse or pension cashier, so just or Riester, and then there's the private pensions. Right? So and if we are talking about Rürup, as I said, it's for self-employed, freelancers, and higher earners. They benefit the most of it, right? So the tax deduction you can get from Rürup is if you pay. So it's for single persons. Right now, it's a little bit more than 26,000 euros, which is then deductible for tax purposes, right? For married individuals, this amount doubles, right?
Which is a lot.
Which is a lot, right? And the good thing is that we had a reform in the whole pension system in Germany, right? Up to 22, only part of it was deductible for tax purposes, right? That deductible amount increased year by year, right? But with a tax reform this year, since 23, we are allowed to deduct 100% of your pension contributions up to these maximum amounts, right? So, preconditions, of course, there are a couple, so which has to be fulfilled. I mean, that's always right. So because these pension have to serve a purpose, then the conditions have to be fulfilled. So that's one. It should be a contract concluded after 24. It has to foresee a payment of a monthly constant or increasing life annuity.
That's why only Rürup, yeah.
Yeah, right. And it cannot start before the age of 62. It's continuous payments, right? Then, of course, you have to confirm that the data can be exchanged, so that's a data protection rule, and only concluded with an insurance company which is registered within the EU.
Very important, yeah.
Yeah. So a US insurance will not be will not qualify. So as we have a high tax deduction, and if you pay your contributions to it, then of course taxation will also, and that is at the payout. You have a full taxation at payout then.
They want the taxes at some point, yeah.
They want the taxes at some point. But here it's also, since previously you only can deduct part of it, the amount which is taxable at payout decreases or increases also, right? So in, let's say the payout in 23 would only be taxable at with 83% of it. but the maximum 100% taxable to be reached in the year 2040. So I would assume most of you would have to tax 100% of it.
Probably.
But you also have to consider, depending on where you're living at that time of the pension payment, again, you have to look at the double tax treaty where this amount is taxable. Right? So then and as I said, this Rürup is basically it's similar then to the governmental pension. So the
tax wise,
yeah, tax wise, right? So, but the contributions to the governmental one are limited up to a maximum, right? But this maximum is lower than the deductible amount of 26,000 for a single. So therefore, if you would like to invest, you can put up to that maximum amount other contributions into these such a rural plans, right? So then we have company pension schemes, right? So it's important to know that the employers are required to offer you that. So if you're asking for that, so they have to provide you with something. So that can be a direct insurance or pension cashier. There are also limits, right? And there are also basically preconditions to be fulfilled, right? You have one which is relatively easy. It's a direct commitment. So it's an Direktzusage. So, but that is basically if your employer says, so if you retire at the age of, let's say, 67, you get X amount pension. They accrue for it, you do not pay anything into it, and you get it. By that, to be honest, that is usually for upper management.
Yeah.
Right? So CEOs and CFOs, they usually get it on higher management. So, company pension scheme, what is important? So it has to cover at least one biometric risk, which is old age, death, invalidity, right? There has to be a connection to the employment. So it's only possible if you're employed. And you can claim the benefit if that biological event occurs. So if you get disabled or if you reach the pension age and so on. Yeah. And of course, then the biometric risk has to be covered by that. Tax-wise, if you're talking about the direct commitment, Direktzusage, only employer contribution, tax-free at the contribution level, so that's usually an accrual, right? So it's also called basically deferred compensation. There's no social security on it, and full taxation at payout, right? So, and if I say it's also a kind of deferred compensation, that is also a possibility which is offered to the upper management that they can defer part of their remuneration into such a direct commitment, but it has to be done before they are eligible to that. And so let's say if a bonus payment is paid out in April each year, they have to say in January, February. So if I get a bonus, I would like to have it deferred.
So that it goes directly into the direct commitment.
That it goes directly there. That is right. That is the only way to avoid the actual taxation. And then, I mean, that's basically then again a cash flow question, right? So yes, you can save the taxes on these amounts, right? And usually the assumption is that if I'm at the retirement age, I anyway earn less, and then my tax rate is anyway lower.
Yeah.
Right? So that is the ratio behind it. But you cannot use the money. The money is frozen for the next 20, 30, 40 years.
So tax-wise, it can make sense if I work now and have a relatively high tax rate. I do something that is tax deductible. because later when I'm retired and I have a lower income, I have to pay taxes, but my tax rate is probably a lot lower than it is today.
Yeah.
That's the idea.
That is right. So, and with the direct commitment, deferred compensation, it works up to 100% of the amount. Then for the other ones, so Unterstützungskasse, which is support fund or direct insurance or pension funds, there are limits, right? So the limit is basically the employer contributions are tax-free and no social security up to 8% of the threshold for pension contributions, which was 7,022, right? So it's not that much, but it's sad, right? For social security, so then the lump sum taxation is possible, so that you only can pay 25% tax on it, and then you are done with it. And then the taxation at payout basically depends on how the tax treatment was at the time it was contributed. So if you have a lump sum taxation of 25%, it is already taxed, right? Then there's no taxation. If the taxation was deferred, then of course, then you have the taxation at the first. Riester right now is under discussion. It is under discussion because they say that what you get out of it does not really make economical sense. So because the companies who offer Riester, the Riester is usually capital based. There's also Wohn Riester, so that's a special rule, but mostly it's capital based. And then there are restrictions how they can invest the capital, because they have to guarantee that at least what was paid in has to be distributed to the individuals, right?
The only pension with a minimum enforced guarantee,
so but that limits them in how they invest the money, right? So, and that's the discussion is, if I would do it on a private basis, you could get more out of it. So, right, so that's about Riester, right? I mean, you can do it, there are tax advantages, and then you basically have to decide by yourself if it doesn't make sense, right?
So maybe if there's a family, right? So most people that, because expats love it because you get the government, you get tax benefits and government bonuses. So every adult gets 175, which is nice. But myself, for example, as someone without kids, I wouldn't get a Riester for myself. If you have 2 kids, maybe then it looks different.
Of course, then you get the child bonus as well, and then So, I mean, who is eligible for Riester? Anybody who is insured in a statutory pension scheme, and who pays a minimum contribution into this certified plan. It has to be certified plan, of course, right? 4% of the salary, up to the 4% of the contribution limit, right? So, but maximum 2,100 euros. So, you get the allowance or the bonus only pro rata if you contribute less than this amount. And then you have individuals who are indirect eligible, right? So these are basically spouses, registered partners of a direct eligible person. Of course, you have to pay the minimum contribution. This one also gets only the full contribution if the eligible partner pays the minimum contribution.
Yeah.
When filing the tax return, there will be done a beneficiary test, right? So, what is more beneficial for the individual? To have the bonus payments, right? Or you get a tax deduction for the contributions plus these bonus payments. And if the tax saving from the deduction is higher than these bonus payments, then you get the tax deduction in addition, basically. Right? And at payout, then of course it's taxable because you have a tax deduction or you got.
Yeah, exactly.
Yeah. So then One important point with pensions, I have to mention that's about foreign pension schemes.
Mm-hmm.
Yeah, that often happens if an individual is assigned or basically comes for 3 years on a local contract and then goes back to the home country, but basically stays with the employer. Then you might think about still paying into that home country pension scheme of that company. That's not a good advice because foreign plans are usually not accepted for German tax purposes.
Okay.
That means if your employer pays contributions into the plan, it's taxable. If you pay contributions, they are not tax deductible. Right? But still, at payout, they are taxable. So then you have a double effect.
Yeah.
Yeah. So stay away from it. If you move to another country, then only pay into the pension scheme of that country where you're working. Right?
Okay.
So there are a few tax treaties which basically deal with that topic, like with the US, right? In Article 18A, so there's a provision, but also here again, the acceptance is limited up to certain amounts, which are not very high, right? So usually contributions into, let's say, a 401k plan are higher than what would be accepted by the German authorities according to the double tax treaty, right? So that is, keep your eyes open on this one.
Okay, good tip.
And then the third layer, these private pensions, they usually do not fulfill the requirements as we have mentioned before, and therefore tax deduction is in a lot of cases not possible. They are also not accepted that they transfer the data to the tax authorities and so on. That's a private decision economically wise. They might be a good product, right? So that basically this pension insurance invests your money in a good way and you get a good pension out of it, right? But then since that is basically out of tax income, then the tax treatment at payout, you have to look then at the payout where it's taxable and if only part of it is taxable and so on, right?
Yeah. Which is where you're usually getting the tax benefits, right? In level 3, you get them in the payout phase after 62. If people have further tax questions, Dirk, how can you help?
I mean, of course, you have to contact me, right? And then basically what I do is I conduct a Zoom meeting for a quarter of an hour to get to know the person, the requirements, and the topic and the expectations. And then tax advice has a lot to do with trust, right? So both parties, so you and I have to say, okay, we can work together, right? It does fit, right? And I have the trust in that person, right? And then based then on the information I get from the interview, then I can basically talk about the process, how it works, and of course also about the fees. What does it cost?